Good afternoon, everybody. Hope you enjoyed that short video. My name is Tom Goold from Valiant Wealth. Welcome to our webinar. We're going to kick things off now. We've got most people have joined us. I've had a few emails saying people haven't had the link. I've sent it out several times. It comes from Zoom, so there's not much I can do, but we'll be sending out a recording. Obviously, if you're not in it, you're not going to hear this message, but yeah, we're going to carry on, press ahead anyway. So this is the agenda which I emailed through to a lot of people last night who have signed up. First thing I'll say is we've been overwhelmed by the response. We're really grateful for everyone giving us their time this afternoon to participate in this webinar. We've got a huge spectrum of people participating. Some have been here in Italy for many years, some who are just thinking of making the move here post-Brexit or for whatever reasons. So it's very difficult to have a webinar which has everything relevant to everybody, but we do hope that you will find everything interesting and of value somehow or another, either now or in the future. So each of these parts could really be a webinar on its own, but we put it all together, and there's a lot of good stuff which we've had to leave out. So stay on our mailing list, and if we have future webinars, then we can cover other topics as well, which are relevant and important. So we're going to start off with looking at the tax regimes. Some of you will know about these already. Really, we want to approach it from the angle of what are the opportunities. It's not just saving money in tax, but what are the opportunities from the context of more holistic financial planning. Secondly, we'll be moving on to flowing into tax and investing as an Italian resident, how to do it compliantly, how to do it most effectively and tax efficiently, and what the options are there. Then we're going to address UK pensions, what you should do if you've got private pensions in the UK as well as state pension, the options available. Also considering that a lot of UK banks are now threatening to close accounts for EU residents, which is going to create some problems. There are solutions, and it's all about being proactive on that. And then other considerations, currency and maintain the bank account, as I mentioned, post-Brexit. There's opportunity to ask questions. You can do that as we go along. There's a little box at the top. You can type your question in. It's anonymous. No one else is going to see it. If it's something very specific, you might be more comfortable just emailing us. So please feel free. Altogether, this should last about an hour with about 10 minutes at the end for Q&A. We don't mind overrunning a bit, but clearly not still going to be here in 2 hours' time chewing the fat when there's no need to. And I should just say, just for housekeeping, this is for information purposes. If you want the advice, then that's what we're here for. So please get in touch. I'll just introduce the panel today, who we have with us. So this is our company, myself and Adam, Valiant Wealth. We're both long-term residents of Italy, very much committed to living here, both married to Italians, both got young families here. And we are international independent financial advisors, if you like. We have clients all over the globe, but because we're here in Italy and we understand how things work, we do have sort of strong representation here. We're part of a UK regulated group, which we think is very important in terms of bringing fee-based advice, 100% transparency and trustworthiness to the sort of expat industry, if you like, which doesn't have the best of reputation. So we do our best to be an alternative to that and put our clients' prosperity first and come from the angle of holistic financial planning and finding solutions to problems. We're both regulated here in Italy as well through IVAS and CONSOB, who are the insurance and investment regulators respectively. And yeah, so as I say, we take a holistic approach, which is why we partner with Colin Jamieson, and our businesses are very much complementary, and we're able to refer people to each other. So there you see Colin, originally from Scotland. He's the better looking cousin of Billy Connolly. His jokes aren't quite as good, but he's a tax advisor, so it's not important. He's a solicitor of England and Wales and Avvocato Milan. He's been resident in Italy for nearly 3 decades, has a long CV working for the likes of Coopers and Lybrand, Deloitte in the UK, and PwC in Italy before setting up his own firm. And he's also been Vice President of the British Chamber of Commerce, so very active in the expat community. I'm sure some of you will know his name already. Just a bit more of an overview. Italy, if you're thinking of moving here, you may hear sort of mixed reports about what life's like in Italy. We all know about the good things, la dolce vita, ma Italy can have a reputation of being slightly bureaucratic and a bit challenging. This is true, but it's not impossible. If you go with the flow and you work with the right people, you'll find things are a lot easier. If you get the right advice, then there's a lot of opportunities, which is really why we exist and why this webinar can be so valuable. So you can have a great life in Italy. I think compared to retiring to other European countries, I think Italy really has a lot more to offer. Okay, so moving on to the webinar itself, looking at the first tax regime. I think, Adam, have you unmuted? You're going to introduce this topic.
Yep, thanks, Tom, and good afternoon, everybody. The first section is about the tax regimes for new residents. Most of you are probably aware of these. Over the last few years, Italy has introduced a number of beneficial tax regimes to try and encourage people to move to Italy. The first one we're going to look at is the 7% tax regime for pensioners. So this is a flat tax for pensioners. It's probably the most popular of the three that we're going to talk about. I mean, Colin might might think differently, but certainly for people moving to Italy, those who are looking to retire here, it's pretty beneficial. To qualify for it, you shouldn't have been a tax resident for the previous 5 tax years, and you must be in receipt of a pension. You must be able to demonstrate that you're receiving a pension income, and you need to become resident in one of the participating regions. There's an aspect to this regime where it's intended to help the economies of some of the poorer regions. And for that reason, to qualify, you must become resident in one of the smaller towns in one of these poorer regions. So a town with less than 20,000 population in Sicily, Sardinia, Campania, Basilicata, Abruzzo, Molise, or Puglia. And income is taxed at flat 7% rate for 10 years. And you have exemption from declaring foreign assets as well. So there are a lot of opportunities within that. I'm going to pass over to Colin to explain in a bit more detail, because obviously Colin is qualified to do that. So Colin.
Hello, hello everyone. This is a really really neat regime. It's obviously the Italian response, as Adam says, to competition from other member states, and very much designed to get wealthy pensioners into Italy and spending money in some of the poorer parts. So, as Adam says, the area's well defined. The Mezzogiorno. You need to have a town with less than 20,000 inhabitants. Interesting to note on that the law actually says you lose the regime if the town goes over 20,000 inhabitants during the course of the 10-year period that you can get it. I've not come across any towns that are on the cusp of going over 20,000 yet. I think it's fairly unlikely, but you do need to be aware that if you're buying property or renting property in a town with 19,900 residents, then there's a risk that the relief will be taken away from under the carpet. Apart from that, there are not a lot of other uncertainties. I think where we are, I mean, it's a new regime, and therefore these always take a little bit of time to settle in. We're just waiting on a response from the tax agency for a better definition of what pension means under the legislation. The legislation is pretty wide, and includes any kind of pension. The Italian tax agency have come out recently with a couple of clarifications for other matters, which says basically if it looks like a pension, it is. So it doesn't need to be a state pension. And I've just got a little bit of doubt about some of those pension products that you can buy over the counter abroad. So non-occupational, non-regulated pension schemes. And I think what we're telling clients at the moment is that if you've got any doubt about whether your pension qualifies, we can ask for a specific ruling from the Italian tax agency. It's a named request. You put in all your details, fiscal code number, all the rest of it, and they will give a written opinion as to whether your pension scheme actually qualifies. So what don't you get? So the 7% tax, you're paying 7% not just on your pension income, but everything else, as long as it's got a non-Italian source. So it must be foreign income. So that means you'll be paying tax at normal rates in the normal way on any income you do from work that you actually carry out in Italy, whether that be employment, self-employment. If you're renting out the property in Italy, that rental income will still be taxed. Investment income, and here I think the government's missed a bit of a trick, because if you decide that you want to, spend your future in Italy and therefore walk into your local high street bank here and buy an investment product, then you're going to be taxed at that normal rates, typically 26%. Whereas if you carry on investing at home, you're going to be paying 7%. And I think they've kind of missed the point there a bit. The idea is to encourage people to spend in the Italian market, not just restaurants and getting your car repaired, but also moving some of your money and giving employment to the local financial industry. The other thing is that the 7% is a flat tax, and by flat tax, what we mean is that it goes in separately from any other income that you've got, and you're not allowed any deductions at all. Yeah, very simple. So no deductions for refurbishment work, none of the usual deductions that you put through your tax return, healthcare expenses, gifts to political parties, if you ever want to do something like that. It's a flat tax, very, very simple. You pay it once a year. There's no payment on account. But the fact that you can't get any deductions or credits means that if you're paying tax on, for example, UK income, if you've got a property in the UK, you're renting that out, as a resident of Italy, you have to report that income here. And typically, and the UK also has the right to tax it because the property is situated in the UK. So you're going to be paying UK tax if you're above the threshold of 12,000 personal relief in the UK. But you can't take that tax that you paid in the UK as a credit against that 7%. You have to pay both. The only exception to that rule is that you can do a country by country opt out, but it is a country by country. So if you opt out on your UK rental income, then you're also opting out on UK source investment income, dividends, interest, whatever. So it's a little bit cumbersome. So that's what one disadvantage of the lower. On the other hand, it is a lower rate, nice and simple, pay less, and you don't need to worry about getting receipts for all your deductions in the normal way that we do at the year end. Okay, shall we go on to the next one? Anyone got the other benefit of the 7% tax regime is that you are exempt also from what the Italians call the tax monitoring requirements. There's a section in the Italian tax return, we call it the RW, where an Italian resident taxpayer normally is obliged to declare their foreign property. You need to disclose the value of it. The value's got a technical definition, but you need to disclose the value of your foreign real estate and any the legislation actually talks about financial products. The idea with both these taxes is to kind of replicate the tax that you would pay if you had an Italian asset. So EVA is the same principle as IMU, which is the tax that you pay on the ownership of real estate in Italy. The rates more or less the same, but obviously the taxable base is different because IMU is based on a land registry value. For financial products, if you invest through an Italian bank or other intermediary, you'll be paying a 0.2% stamp duty annually on those products. So these two taxes were brought in to try and make it a level playing field and not give any incentive for Italians to invest outside Italy by reason of the tax. Now, the taxable base for real estate is principally the purchase price. There's a ministerial circular that's gone all around Europe, again, trying to create a level playing field, and has looked at similar taxes in Europe and has decided that while the UK was a member state of the EU, it's possible to use the council tax band value. I typically take the middle of the two, but you know, some clients take the lower end of the band, and pay your tax on that. And obviously, if you've purchased in the last 10 years, particularly in the southeast, the council tax band will be a lot less than the purchase price. But that, I think, is going away after Brexit, and so the Italians won't be obliged. They might decide to continue it anyway, but they won't be obliged to continue to offer that favourable treatment. So for real estate, the basic rule will be you pay on your original purchase price, as shown in the deed, and you need to have the original purchase documents to hand if the Italian tax agency want to ask. And if you don't have them, you pay on the market value, which it could be a significant hike. The EVAF is typically payable on the market value of the investments. So the closing year market value as shown in the certificate, so the statements of the bank or the foreign intermediary. Now, on the 7%, the good thing with the 7% is that you don't need to worry about any of this. For the 10 years that you're in the regime, you are exempt from having to pay that tax and disclose your foreign assets. And so I think, Adam, you might want to say something about it later on, but it is a 10-year period, and you really need to think about, during that 10-year period, about what's going to happen after you come out. I mean, it's difficult to find assets that are exempt from these wealth taxes. You know, whichever way you turn, there are schemes on the market, as there always are, being offered by various accountants, brokers, designed to try and help evade these taxes. I'm not a great fan of any of them. That they work as long as you don't get found out. But there is a bit of planning that you can do, maybe more on the income tax side, to shelter the income, defer the tax basically, and there may be some ideas on foreign real estate, particularly if it's put together with succession planning. So passing the asset into other, the future generation, get it out of your name, or at least get the beneficial ownership out of your name, and or even into a trust. But I think that's not going to be justified by 1,000 euros, 2,000 euros of EVA on per annum. It needs to be justified by a large inheritance tax planning, UK inheritance tax planning exercise, and we'll talk about that later. Back to you, Adam.
Yep, thanks, Colin. So yeah, that was pretty detailed. The 7% regime might not be the best thing for rental income in the UK. But there are a number of financial planning opportunities. So we've got a few points down here. The exemption from IVAFE allows efficient use of an investment platform. During the 9 years, capital gains and income are taxed at 7% rather than 26%. And this is around the point that Colin mentioned, where the Italian authorities have missed a trick a little bit this, because they could have encouraged people to, when they move to Italy, rather than leaving their assets outside of Italy, to be encouraged to move them within Italy, which would obviously help the economy more, but they seem to have ignored that completely. And the result is that there is a situation where it's actually better during those 9 years, or the 9 years of the scheme, which is 10 years basically if you count the first year, to keep your investment assets outside of Italy. Now, one issue with that is that you also don't want them within another withholding tax regime. So there's an opportunity to use an international investment platform, which is outside of any withholding tax regime. Still, we have, there's one that we use that's an FCA regulated platform, so it's still a UK based platform. It just, the custodian bank is outside of the UK withholding tax regime. So there's no tax at all within the actual structure. And what that means is that every year you would declare capital gains that might have arisen if you sell an asset within the investment portfolio, and it generates a gain. And rather than paying, if it was shares in Italy, the rate is 26% tax on gains on shares. It's 12.5% on government bonds. But mostly you fall into the 26% bracket. While you're under that regime, you'll just pay 7%, and that goes for dividends as well. So obviously that's quite beneficial. And with the pensions, if you were accessing a UK pension during the 9-year regime, with Flexi Access Drawdown, you can take advantage of those years when you're under the regime to withdraw the money. So rather than taking what you need to spend, you could increase and draw down the pension during that period, because if you draw it later, once you're out of the regime, you'll be paying a higher rate of tax. And it gives you the opportunity to take that capital out of the pensions, put it with your, potentially with your other assets. And as you approach the end of the regime, of the 9-year period, you can, so in year 9, you could release the capital gains that built up within by selling and paying your 7% rate then. And if you're intending to stay long term in Italy, there's some tax efficient structures, so tax wrappers that you can use, which we're going to talk about a little bit later. But what you can do is some financial planning whereby you use the regime to draw down the pension, to realise the gains on the assets which have grown, clear all that out, and then put it into a tax efficient structure ready for when you become a normal tax resident in Italy. So it's a long-term plan, but that's something that we can help people with, and it's pretty beneficial when you look at how it all adds up. There's also the case of final salary pensions, defined benefit pensions in the UK. They're becoming very, very difficult to transfer. So it's expensive to transfer them out, but because of the bond yields, the transfer values have been extremely high in the last few years. So if you're coming under this scheme and you have a large DB pension, you might think about transferring that out before becoming a normal resident, and investing it in this way, rather than having large payments once you become a normal tax resident. I think, is there anything else to add on that, Tom or Colin?
I don't think so. I think there's lots of interesting opportunities in that you've covered.
Okay. Should we move on?
Yep.
So, Colin, I'll go back to you on this. This is another one of the favourable tax regimes, probably the one with the lowest uptake, we think, don't we?
Yeah, I think so. I'm not seen statistics for everything, but I understand there's been about 400 applications since this was introduced. This came in a couple of years before the 7% came in. This is the what the Italians call the HNWI, high net worth individual regime. Again, designed to beat the competition. The UK's had very successful non-dom tax regime for many, many years. And that's been very successful in attracting the wealthy from other countries to come and buy property, come and invest in the UK. And so I think the Italians thought we'll have a slice of that as well. And when they introduced this regime, they introduced side by side some quite favourable visa application rules, so making it easier for people who were coming to take up residence in Italy and make investments to do so. So this tax regime, very simple. You pay only 100,000 euro every year, flat tax, and that's like the 7% regime in place of normal income taxes and the wealth tax, the EVA and the EVAF that I talked about before. Again, one installment of 100,000, and you can tack on family members, and you pay only 25,000 for each of them, and they're also excluded. Their foreign income, non-Italian sources excluded. So, like the 7% regime, it doesn't cover. The perimeter is for foreign source income. If you come to Italy under this regime and start working here, either self-employed or an employee, or rent out property or invest in Italian government bonds, then you'll be liable to tax in the normal way. This regime, there's a very useful Italian tax agency circular, which explains their take, the Italian tax agency's take on this legislation. Legislation in Italy tends to be pretty kind of concise. These two sections of the tax code, Article 24 bis, which is this one, Article 24 ter, which is the 7%, they are, they're a page long, a page of A4, you could fit them in on. So the tax agency explanation is very useful. On the 100,000 regime, they've explained that the Italian controlled foreign company rules, most of the anti-avoidance rules, so these are rules that are designed to stop Italian residents setting up companies in tax havens abroad, in order to avoid paying tax on the profits in Italy. The Italian tax agency is allowed to sort of suck all the profit out of your Cayman Island company, Bahamas company, and charge it to tax. The tax agency have confirmed that for the 100,000 tax regime, those CFC rules, those anti-avoidance rules, are not going to apply. We don't have the same guidelines on the 7%, so we've got a little bit of doubt about exactly what kind of anti-avoidance rules could potentially apply. But that's only a worry if you've got income if you've got income deriving from companies, your own controlled company in jurisdictions where you don't pay much tax. And this regime was made famous by I forget his name now, Ronaldo going to Juventus. The word on the street was that he took advantage of this, but of course the advantage is only for Ronaldo's non-Italian source income, which I imagine is quite plentiful. But his wages as a player of the club, they'll be taxed in exactly the normal way.
Yeah.
Okay.
Yeah. I think as well, one point to add, it's not, you don't have to be a super wealthy individual to qualify for this. Someone who's built a business over several years, several decades, you know, could benefit from this more than the 7% regime coming to Italy at a certain stage in life. So, you know, it's not one that's just out there for the likes of Ronaldo. I think there's probably more people that can benefit from this. Yep, moving on. Next, final tax regime that we wanted to look at in detail for new working residents. Colin or Adam, you want to take this one?
Shall I have a go?
Yep, go ahead, Colin.
So this regime here, another regime designed to get people to come and work in Italy. This originally started off as the rientro dei cervelli, so getting anti-brain drain. It started off as getting Italians, an incentive to get Italians to come back and work in Italy. Then somebody pointed out that it was a little bit discriminatory, that under EU rules they couldn't do it just for Italians, so they extended it to all EU citizens, and then finally they extended it to just about everyone, as long as you're coming from a country that's got some form of tax cooperation agreement in place, then you can take advantage. And the advantage is basically a 70% exemption on earned income. And this one only applies to earned income, self-employment or employment, and you get that 70% exemption for 5 years. If you're moving to the south of Italy, the exemption is 90%. So you're only paying tax on 10%. If you're either going to the south of Italy, or if you're coming to work, if you're a professor or a researcher in a recognized, needs to be a university or recognized institution. It's not just anyone doing research, you know, from their office. It needs to be recognized. You need to have been resident outside of Italy for the past 2 years, and you need to make a commitment to remain here for at least 2 years. We're seeing the tax agency. This regime has been in place in its more or less current form since 2016. The original law was 2011, I think. So we've had a little bit of experience of how the tax agency reacted to it. We're seeing they're being pretty aggressive on checking that you've been resident outside for two tax years, and they're also asking you to show. The legislation talks about you have to commit to stay in Italy for at least 2 years. For me, that's a commitment, which means that you can change your mind. You may have to have good reasons for changing your mind, but as long as you've made the commitment, then that's fine. The authorities are interpreting that as you must remain here for 2 years, and so we've got one case on where we're fighting a tax agency claim to get the money back, the extra tax, because the guy didn't stay here for 2 years. Now that the regime since 2020, so people arriving, becoming tax resident with effect from financial year 2020, so arriving basically any time after after June, end of June 2019, they can extend for another 5 years. The rate of exemption goes down, the exempt portion goes down to 50%. And in order to get that, you need to have at least one dependent child. That means either a minor or a child in full-time if not a minor in full-time education, or purchase real estate. And there's some timelines on when that real estate needs to be needs to be purchased, and you get an extra increase if you've got at least 3 kids. So the exempt part goes to 90%. So a little bit unfair for those who arrived in 2016. They don't get the 5-year extension, but that's the way the legislators' cookie crumbles. Now we've got a lot of clients coming in under this regime. Particularly I don't know what it's like in Rome, but here in Milan, the multinationals, fashion houses, the well-known the Italian brands, international companies, have been recruiting very hard and moving managers back to Italy over the last few years to take advantage of this. One thing I should say is that this regime doesn't apply to Social Security, and as anyone who has to pay Italian Social Security knows, it's expensive. And so the reduction here is a reduction for tax, but not for Social Security. So you're still going to be paying the full whack of Social Security. But notwithstanding that, as I say, here in Milan, it seems to be quite successful. And up until the COVID pandemic, we were seeing a real increase in movement of individuals being hired, recruited here in Italy under this regime. And of course, the multinationals are realizing that they can offer a lower gross pay, for the same net, and so they get their slice of the action as well. Now, for a lot of people, we do simulations looking at these favorable tax regimes. And if you're earning up to 65,000 euros a year, typically the regime forfettario is the better regime, if by better you mean paying less tax and less Social Security. I'm not sure that I should say that's necessarily better, because telling young people to provide for their retirement and make bigger pension contributions may actually be better. But if we accept the better for the moment is paying the least amount at the moment, or paying the least amount into a state scheme like IMPS, then the regime forfettario is a better regime. And that's a regime where you pay a flat rate 5% tax on a percentage of your gross income. There's a coefficient that reduces your gross income typically by 22%. So the tax regime is very favorable because you're paying 5% on 78% of your gross billings. And Social Security, by the same token, you're paying the Social Security on 78% rather than 100%. That regime forfettario is, say, only available to the self-employed, but it's also a great regime, coming back to what I was saying on the 7% regime. So if you are a pensioner and you want to do some work from your home in Italy, you can do so. You're still entitled. It doesn't affect your entitlement to the 7% regime on foreign income, and you can consider the regime forfettario, the 5% flat tax regime, for any extra work that you're doing by way of self-employment. And as long as you're below 65,000 euros a year gross billing, then that's a really nice, simple, easy regime to manage. A lot easier than the normal self-employed regime, which for non-Italian speakers or people who are conceptually not used to the Italian way of doing things, can be quite scary. The complexities of getting yourself set up employed under the normal regime. Okay.
Yeah.
Okay, good. Yeah, I think that's covered the tax regime. Before we go on to the next part, we've had quite a lot of questions coming in. We're going to try and answer them verbally at the end. I think we're trying to actually type the answers into the box now as well, just because there's so many and may not have time to cover them all in depth. And they also, a lot of these questions make interesting case studies anyway, so hopefully they'll be of value to more people than just whoever's asked the question. So Adam, I think you're going to discuss now the most efficient way to sort of invest as a resident in Italy.
Yes, yeah. So if you're not under the 7% regime, there is another way to invest quite efficiently. Well, this is pretty much the only way to invest efficiently as an Italian resident. This is what you'll find a lot of Italians doing. Italian high net worth individuals will use this type of structure that we use, but there's also more basic level structures which are available from Italian banks and insurance companies, although the costs are generally pretty high. We use these for people who are investing more than 250,000 euros. They're basically an insurance structure, so we call them tax wrappers, but they're actually an insurance contract with an investment, a custodian bank and an investment portfolio within it. The ones that we use are Italian compliant in that the insurance companies that provide them, although they are based outside of Italy, which many people see as being an advantage, they have branches in Italy. So they're Italian compliant, which is important in some senses because for convenience purposes, it means that they can act as withholding tax agents. So if you invest into one of these, you do away with the sort of complication of having to report it. And sometimes we touched on talking about investment platforms when we're talking about the 7% regime. If you have a portfolio, an investment portfolio, which has a lot of adjustments made to it, and many transactions, all of those transactions need to be individually reported, which, as Colin will tell you, can become quite cumbersome. But with this type of structure, all that is reported is the value at the end of the year, which has a number of benefits to it. So the change of assets and tax, which would have been tax liabilities that would have been generated within the structure over the course of a year, don't need to be reported. In fact, all that is reported is the value. So what you get is a kind of gross roll-up of incomes and capital gains within the structure. You only pay tax when you actually make a withdrawal. So if you keep it for a long time, if you imagine that you have a number of assets which are being sold and have a 26% liability on the gains, those gains remain within the structure, and then you get further investment growth on those over a number of years. So if you're holding an investment portfolio for a long time before making withdrawals, this can work quite well. You also offset losses that you might make on other assets, because obviously the individual assets are not being reported. So if you make a loss on one and a gain on the other, you're offsetting those for tax purposes. We use these quite often with people who are coming to retire in Italy, not those under the 7% regime during the first 9 or 10 years. This would be the type of structure that you would use after that, because actually they have an efficient withdrawal mechanism, whereby when you do make a withdrawal, you withdraw mostly your initial capital in the early years and part of your growth. So you pay quite a minimal amount of tax, certainly in the early years of withdrawals. So the way that works, for example, if you had 100,000 invested and it grew by 5%, you'd have 105,000. If you were to make a withdrawal then of, say, 10,000, you would withdraw, because 10,000 is about 95% of 105,000, you would withdraw 95% of your own capital, and then on the other 5% you would pay the 26% capital gains tax. So it's quite a small part of the taxation. The rest gets deferred until much later, and then you get the benefit of the gross roll up and the gains on that. Another big benefit of these is, especially for Italians, is the inheritance tax, that you appoint beneficiaries to these because they are essentially a life insurance contract policy. So you appoint beneficiaries. When the policyholder dies, these don't go through probate, they get paid out directly to the beneficiaries, which is an advantage because Italian probate is set in the way that it works. I mean, Colin could explain this a lot better than me. But also the proceeds are not subject to inheritance tax in Italy. I mean, it might be if you're UK domiciled or considered UK domicile, then you would. And we were actually talking about this before, about how easy it is to show you're not domiciled, not UK domiciled, and people who've lived, was it 15 out of the 20 years, Colin, that we, for the, you're on mute actually. I think Colin is still on mute. I'm not quite sure why that's not working, but I think it was 15 out of.
Am I still on mute?
You're back on now.
I'm back on, right? Okay, sorry.
Yeah.
Technical
That's
hitch,
right.
pressing the wrong button, as so often happens, says my wife. To lose your UK domicile, you'd need to spend. I mean, everyone's got a. The real problem is that you can't sort of write off and get a form from HMRC saying you've lost it. So basically 15 out of the last 20 years. But if you evidence an intention to return to the UK at any time, so the classic textbook example is your purchasing your burial plot in Northampton or wherever, then that might allow the authorities to say we want a slice of the inheritance tax. But basically you lose it by simply declaring an intention to move away from the UK, and an Italian citizenship application would be a good indicator. But you've got to look at everybody's case in the round.
Yeah. So if your intention is to remain in Italy long term, it's possible you might be able to benefit from that as well, or well, your family might be able to benefit from it. Another important aspect of these types of policies and why they're quite popular with Italians, Italian nationals, is the security of assets. Obviously, the Italian banking system is not the strongest in the world, and by using one of these policies, the assets are actually extremely secure. When you use a custodian banking arrangement, assets are segregated. So in the case of bankruptcy, the institutions that hold them can't actually use them to pay off their debts. So that's something that's quite attractive to Italians, as well as the fact that the Italian government find it quite difficult to get their hands on these assets if they want to freeze them and so on. Although they probably would be able to eventually. There's also flexible investment options. So these are open architecture structures. So there's really is a wide variety of ways you can invest within them. You need to appoint an investment manager though. You cannot be managing your own investments within these structures. If you are seen to be doing that, they would lose the tax benefits because the Italian authorities would see that you're using this purely to avoid tax. And you can add additional insurances into the structure. You can actually, if you're using this purely for inheritance tax planning, you can actually add insurance and insure the capital value, so the value that you put into it at the start. So then you can, even if you're taking higher investment risk, if you were to die when the value of the portfolio is below the initial value that you put in, then the insurance company will pay out the original value of it. So that there's these kind of options around it, but they really are the best way to invest if you have larger amounts and if you want to invest for income. So using it a bit like a pension to provide you with income over a long term. These are the best type of structure to use. Tom, do you have anything to add to this? Tom?
So I was on mute talking to myself. No, I've been trying to answer some questions. I think you covered everything on there. Someone asked, yeah, so there's a minimum there, 250,000. Below that, really, the benefits don't necessarily outweigh the costs. I think there are other firms offering non-compliant Italian structures for lower amounts, but really just so they can generate themselves large commissions. So if you're looking to invest and get in touch, and we can make a comparison and show what would be most best for your situation.
Well, yeah, for smaller amounts, I mean, using an investment platform is also okay.
Exactly.
The problem that you have with an investment platform is if you make a high number of transactions. If you have a portfolio that doesn't have a high number of transactions, the reporting is relatively simple. Although with this type of structure, which is not actually written on here, but you don't pay a VAFE as well, even though the assets are outside of Italy. So the 0.2% of VAFE that Colin spoke about earlier, you don't pay it with this, but you would pay it with a platform. It's a bit of a toss-up. I mean, we don't tend to do these for smaller amounts just because it's kind of economies of scale. This is a much more sophisticated type of structure, but if you have a larger amount of money, it doesn't cost you any more than having an investment platform. The costs are actually relatively reasonable. Obviously, sorry, go on, Colin.
I was going to say that although you don't pay the 0.2% IVAFE, you've still got the 0.2% stamp duty.
Yeah.
So same tax, different name.
Yeah.
Should we move on, Tom?
Yeah. So relevant. Yeah. Contrasting it to the straightforward investment platform, which we've already talked about under the 7% regime, where you don't need the bond. This can be an easier solution through which to invest. Adam, if you wanted to. Or am I doing this one? I don't mind. So we, I mean, we have these platforms available, which are UK regulated, so regulated by the FCA. Assets held securely. Really simple, straightforward way to save and invest without any minimum obligation, without any surrender penalties, without any obligation to have a set amount in there. Multiple currencies available. So if you're in a position where you want to invest some in pounds and some in euros, then you are able to do that as well. And all the technology you'd expect as well to access it online, manage it online with professional advice as well. There's no setup fees involved, no exit fees. And like Adam said, it becomes an economy of scale. So for smaller amounts, let's say 50,000, 100,000, this would probably be a more suitable vehicle through which to invest, where really the benefits of a tax wrapper don't outweigh the cost for those amounts. And like we said, it's really good to use under the 7% regime because of the way the gains are taxed and because of the fact that you don't have to declare it on your tax return. So I think, like we already said, the government seems to be missing a bit of a trick there. I don't know why they don't want people to even declare it, but it's not for us to second guess.
Yeah, I think some of these things are not that well thought out when they bring them in, but yeah. Okay.
So moving on to pensions, I think we've covered everything in that section, Adam. So if we start by looking at the state pension, I mean, obviously we can't advise on state pensions because it's government money, let's say. But we do get asked about this a lot. You know, people that maybe worked in the UK many years ago and they're wondering what's happened to their pension. The best advice I can give you is to check the UK government website, where you can check your state pension there. If you know your national insurance number, you can go on there, you can see exactly what you've contributed over the years and what that's going to be worth to you further down the line. In terms of making this relevant to the audience here of people resident in the EU, you need a minimum of 10 years national insurance contributions to qualify for the new state pension. I think the new state pension is for anyone born after 1951. So it's probably the majority of people we're talking to. But you can use years spent in other EEA countries to count towards that. So if you spent 5 years in the UK, but then another 20 years working in Italy, then you can still get the UK state pension. We don't know what's going to happen after Brexit. And that's also relevant where it comes to the triple lock on the way that increases are applied. So at the moment, if you're living outside of the EU, you don't get any increases in terms of inflation on your state pension. And expats in countries like Canada, South Africa, Australia, New Zealand, America have sort of joined forces and been fighting this, campaigning about this for many, many years and not really getting anywhere. We don't know what's going to happen after Brexit. There's a lot of unknowns. We'd like to think that they're not going to retrospectively penalise people, but maybe just draw a line in the sand and say going forward, okay, the triple lock is not going to apply, but we can only second guess on that. But like I say, go to the government website, even go to, I think, Google Pension Advisory Service. It's a free service for people looking for UK pension advice, specifically around state pension and even other pensions. If you do have pensions in the UK and you're receiving them as a resident in Italy, then you may run into problems where you've got a UK firm unable to advise you or to continue advising you as an EU resident. We've got clients, we've come across people who have pensions, for example, with St James's Place, who are a very large provider of pensions in the UK. And they've said to this couple, we can no longer advise you on your pensions, but they're still quite happy to take the advice fee. And within those pensions, they've got surrender penalties, so they're in a position where they can't even easily move them. Another challenge people are finding is where firms maybe can continue to advise them, but they won't pay into a non-UK bank account. And if the banks are now saying to EU resident customers that they're going to close their account, again, people could find themselves stranded in this kind of no man's land. It's pretty common, pretty much everyone I know as a British expat maintains a UK bank account, even if it's just for spending money when you're visiting in the UK. So we'll come on to that later on about bank accounts, but one simple solution to mitigate all of these problems is using an international SIPP. This is a fairly recent invention. So in 2006, they invented something called QOPs, where people could start transferring their pensions overseas, in majority of cases unnecessarily so. So the international SIPP market, so then a lot of UK SIPP providers launched international SIPPs to allow non-UK residents to open a UK SIPP, but for the transfer of other pensions, not for new money, just for transferring other pensions in, which makes it a lot easier to manage. So I'll run through a few of the highlights of the features of this. So again, it mitigates that risk that your UK pension company won't be able to advise you or make payments to you as resident in the EU. These SIPPs are willing to pay into foreign bank accounts. They're low cost, they're very competitive. If you compare them alongside a SIPP in the UK. SIPPs are very popular in the UK, people that want to self-manage their pensions. I mean, the SIPP that we use, this international SIPP, as it's branded, I mean, it's UK registered, it's really just a SIPP with the word international in the front of it. The costs are actually less than Hargreaves Lansdown, which are one of the largest SIPP providers in the UK. Again, you can access multiple currencies, so this is very, very useful for managing the transfer of your pension from one currency to another. At the moment, it wouldn't be wise to transfer the whole lot into euros, but to sort of phase that over the years. Through these SIPPs, you can manage portfolios side by side, where you could have a portfolio of sterling and a portfolio of euros, and again, sort of phase that transition, as we've said. Again, it's UK regulated. With the FCA, the head office is in the UK, so you're going to be dealing with well-educated English people looking after you there, dealing with the administration. Like any SIPP, you've got access from the age of 55. It's useful to consolidate multiple schemes. and you can manage it easily online with professional advice from companies like ourselves, from using discretionary fund managers, accessing a wide range of funds, ETFs, all the usual popular stuff. We can facilitate that. Anything to add on this, Adam, regarding SIPs?
No, I don't think so. Apart from that point in red about QROPs and the lifetime allowance.
Yeah, so the lifetime allowance is basically a ceiling on your pension, which is kind of about 1,055,000, I think. So if you've got pensions above that amount, you're going to be paying a surplus on drawdown of 25% as an extra surplus charge. So if your pension's around, I know, depending on your age, if it's around 800, 900,000, and you could be reaching that ceiling, and you've got many years to go until retirement, could be favourable to look at transferring to a QROPS. But like with the argument before about tax wrappers versus platform, there's a sort of cost to benefit thing to take into consideration here. QROPS are very expensive, and you really need proper professional advice. So speak to us if you're in that situation. But if you get targeted by any other salesmen who are talking to you about QROPS, then tell them to talk to me instead. Okay. On the subject of final salary pensions, we mentioned this earlier in the context of the 7% regime as a reason to consider transferring it. If you don't know what a final salary pension is, it's basically a pension where you are going to be paid an income in your retirement according to the years you spent working for that employer and the salary when you left. So it's basically a defined benefit that's paid to you from a certain age, usually 60 or 65, increases in line with inflation, continues until the day you die. And then when you do die, there's usually a spouse's pension or a widow's pension of 50% of your own. So these were very popular, let's say 50 years ago, 40 years ago, when people weren't living as long as they are now. Now they're very unaffordable. Clearly, if someone's retiring at 65 and living to 100, it's a big burden on the pension trustees on the scheme. Traditionally, the advice is don't transfer such a gold-plated guaranteed income. But nowadays, there are very favourable transfer values, and you really need specific advice. And the FCA are making it increasingly difficult to be able to transfer these pensions. I mean, in some cases, to give you a couple of examples, I dealt with a couple in France last year, and all they had was this pension. And my advice was don't transfer it, even though they wanted to, and in the end, they went to another firm and transferred it. Anyway, my advice was don't transfer it. It's a guaranteed income. Don't take on the investment risk. Don't jeopardize your future in that way. Other side of the coin, I had a client here, his pension was promising to pay him £2,000 a year from the age of 65, he's currently about age 50, and the transfer value was 90,000. So it's a bit of a no-brainer, you're going to bite their hand off for that 90,000. So my advice is our advice is look at it, consider it, but don't make any assumptions until you have done so. There's some benefits according to everyone's situation being different, but the benefit to access it flexibly, to pass on more when you pass away, to have self-management and control over the investments. And if you're financially secure in other aspects of your life, then you can consider these. If the defined benefit pension is all you've got, then my advice really is to keep it. As we said, it's advantageous under that 7% regime. If you imagine a scenario where someone might be moving to Italy, let's say at the age of 65, they've got a defined benefit pension, which is going to continue to pay them, like I say, until they die. The opportunity to actually take that out, transfer it into a pension where they can draw on it over the 9 years and just pay 7% on that income is probably a more beneficial scenario than continuing with the pension for the rest of their life. So again, it's a complex area where you should take professional advice, but there are advantages there if you want to consider it. Before I pass over to Colin, a bit of background on this. Pensions are quite a grey area, and if you speak to a local commercialista about your UK pensions, sometimes they can be a bit confused just because the Italian pension system and the UK pension system differ so much. So different commercialistas will give you different answers, where someone like Colin will probably give you the right answers. And these are the most commonly asked questions that we come across when it comes to how should you be paying tax on your UK pension? So I'm going to hand back over to Colin to cover this one.
Okay, thanks. Yeah, the fundamental problem is that for most Italians, it's the Italian state that manages their pension. Yeah, you pay to INPS, the Italian state institution. If you're employed, self-employed, the pension contributions are deductible in calculating your taxable income. Employer contributions not a fringe benefit; they're not taxable, and that means that when you get the money out, the Italian law treats pension income as if it was employment income. Yeah, you got a deduction at the standard rates on which you pay income tax on employment income. Scale rates going from 23 to 46, maybe even a little bit more, depends on your region. And therefore, when the pension is paid, it's liable to tax just in the same way as that income and employment. Now, of course, in the rest of the world, the state takes a much smaller plays a much smaller role in providing our pensions, and that means you've just got always got a natural tension between your pension product and especially something like a SIP, which is entirely voluntary, really. For the Americans, their IRAs, Australian superannuation. There's a compulsory element to it. The UK, if you were contracted out of the state earnings related pension in the old days, then you could say that paying into a supplemental pension, or private pension rather, was a bit obligatory. But this gives us a great deal of confusion, and I think overall the best we can say is that it's an open issue. I've just been doing an article on a tax agency resolution which was published in May this year, and it was a pilot asked the treatment of his occupational pension scheme, and the reply of the tax actually was an occupational pension scheme that had been transferred into a SIP, as far as I can make out. And the tax agency quite clear, this is the income from that SIP is liable to tax as pension income, so 23 to 46%. You get a tax credit, so if you earn less than 8,000 a year, pensions less than 8,000, you pay no tax, and that tax credit slowly slips away once you're earning over 55,000. So you've got a pretty hefty rate of tax on that pension income. And now there is an argument that a pension is really just a form of investment. Why, if I've taken my money, particularly my after tax money, and I've put it into a pension plan offered by one of the biggies, Scottish Widows, whatever, then really that shouldn't be taxed as employment income, because we haven't got that mirroring effect. I've already paid tax on the UK on that money. I might have inherited it, paid inheritance tax. So therefore that should be treated as investment income and liable to tax at the flat rate, 26%. Investment income in Italy is put in a separate bucket. Yeah, so however much investment income you get, it doesn't affect your marginal tax rate on your other income, employment income in particular. It's taxed at a flat rate, 26%, or 12.5% if you're invested in government bonds. The Italian government wants to encourage the Italian citizen to invest in Italian government bonds, and most Italians have a lot of their savings in those in the various types of bonds that they offer. And of course, under EU rules, it can't just be Italian bonds. It can be a bond issued by any government anywhere in the world, as long as it's on the white list. So as long as it's not a country that is considered uncooperative in terms of sharing tax information. So that's the dichotomy, and we've got a very clear statement of what the Italian tax agency think, and that's been criticised in the specialist press. I've seen quite a lot of criticism of that, but the tax agencies there, they've got to give their view, make things simple that taxpayers can understand. So on income tax agencies say you've got a pension, whatever kind of pension it is, income tax at marginal rates. Now we've got to think about the tax monitoring, the section RW that I mentioned before, and the question of whether the pension needs to be reported in the tax return as a financial investment. The tax authorities have made it very clear that you don't need to report your state pension. That's not considered to be a foreign financial product. And anyway, you couldn't value it because it doesn't have a year-end value. And that's the problem. But the Italian authorities reckon that any scheme that is not paid, any pension scheme into which you've paid otherwise than under an obligation of law, and it's a moot point now that all the SERPs has gone, whether paying into an occupational pension scheme, which in the UK are now typically outsourced to private providers, whether that is a legal obligation or not. There is a little part of it is maybe legal because I think it was the last Tory government introduced an obligation for Nest for a supplemental pension, but typically most people's pensions are payable pursuant to a contractual obligation, their employment contract. It's a benefit. A lot of people get a salary, have to take a salary sacrifice to get the additional pension contributions nowadays. So there's a problem. The Italian tax authorities say that pension, the year-end value, needs to be reported. If you've got a defined benefit scheme, what on earth is the value? Because there's just a big pool of money, and an obligation on the pension trustees to give you a pension of a certain amount on a certain date. Yes, you can work out the transfer value according to UK government rules, that apply when you want to take your pension out of your occupational scheme and put it into a QROPS or a SIP or whatever. But that transfer value is a kind of fictitious UK government valuation. It's not a market valuation. So that's the first problem. The other thing is the tax agencies say, well, if in order to be excluded from the RW, so you don't have the obligation to report it, it's either got to be obligatory, payable by law, or pursuant to a national collective labour agreement. Now, Italy, almost everybody in Italy who's employed is employed according to one of the national collective labour agreements that are negotiated government unions, representatives of employers' organisations. In the rest of the world, that's not true. I don't think in the UK we've got any national collective labour agreement, maybe just in the public sector, but certainly in the private world, there's absolutely no such concept. And while big corporations have their own standard terms and employment contracts. So again, we've got the Italian legislator who's saying we've got to report things, the tax agency kind of trying to fix simple rules, but without really understanding that the rest of the world works a little bit different. And it's a problem because the penalties for failing to report can be significant. They're percentage, 1% up to 3% of the values that you haven't shown in the tax return. And I typically tell clients, well, you might as well, you're much better showing it than not, because of that penalty. Of course, showing it means that you've got to pay the 0.2% EVAF. on the year-end value of the pension fund as best as you can do it. It's all a bit of an unsatisfactory situation, and I've been calling for some time through my representative bodies. Not anybody pays much attention to me or the problems of foreigners coming to Italy. That we could get some legislative backup on all this and really sort it out one way or the other. The only thing I can really recommend is if you've got large values, you're unsure, ask for a ruling. But we probably know what the reply is going to be, and that is why the 7% regime in the south of Italy is so great, because you just don't have this headache. You will have a headache in 10 years, but in that 10-year period, you may well be able to bust your SIP, subject to the regulatory consents, but you may be able to take a lump sum out of the SIP, close it down, and invest in something different, such as one of the insurance bonds, or the portfolio, or any kind of investment that really doesn't have the word pension in the on the front page of the product. And then you've got so much more flexibility, and worst case scenario, you're going to be liable to a flat rate 26% tax, regardless of the amount. I should have said that you're going to, income tax, you're going to be paying under the 23-46% scale, you're going to be paying an effective rate of 26%, around just under 30,000 euros a year. So part of your income's taxed at 23%. You've got the tax credit, but your effective rate is 26% when you're around, I think it's about 28,000 euros a year. Depends a bit on your personal circumstances, what deductions you can take, but that's kind of the borderline. So a pension under 28,000, you're probably better off following the tax agency guidance and paying tax at marginal rates. An amount over that, you're probably better off paying the 26%. And of course, if you're on the 7% regime, we've got that time so that we can structure the investments so that you've still got a little bit of pension income. A little bit is quite a good pension, even so, 25,000, 28,000, liable at less than 26%, and anything over that is capped off at 26%. And that's really what Italian tax planning is all about, making sure you're making use of the various buckets and the tax credits that are available. Back to you, Adam, or Tom.
Yeah, just one question related to tax on UK pensions, Colin. If someone's been resident in Italy for a long time and they inherit a UK pension from a relative in the UK who's passed away, in the UK, pensions aren't part of the estate. If that person was in the UK, they'd inherit it and pay UK income tax rates. In Italy, what would the situation be? Would they pay income tax in Italy, or would it be under the category of death tax or donations tax?
Well, I think they certainly pay tax on the income, on the pension.
If they get it as one lump sum from a...
I think if they get one lump sum, that's deemed to be a pension, yeah. I think you need to look at the specifics of it and decide is that a pension? Is it actually a pension, or is it, has it already gone past the pensions stage and it's just a lump of cash that's sitting on the deceased account? So if the personal representatives receive the lump sum from the pension fund, because it's a death benefit, then what's getting passed to the beneficiary is no longer pension, it's cash. You've then got to think about, well, is a gift of cash liable to Italian inheritance tax anyway with the beneficiaries resident in Italy? And that's a complex question of the territoriality rules, but you can fix it so that it isn't if you're careful. And there may be a little bit of tax to drop here, to register the death and the gift. But as long as the transfer is outside of Italy, then but you need to have a look at the pension trust. I'm just trying to think what they look at with it, because the pension trust, typically they don't make payment to the personal representatives, do they? They make payment to the spouse.
Yeah, or any nominated beneficiary. So if it's, for example, a SIP in the UK, you know, some pass away, and then the money's still in the SIP when they pass away, then it's inherited by a person resident in Italy.
Well, I think this person has inherited the SIP actually, in specie, as it were. So it's still in the pension. So probably it's going to be taxed as pension income, isn't it?
But further down the line, when it comes out of the pension.
Yeah, I think if you're because most of these SIPs are constituted as a trust. Yeah, the ones I've seen anyway. Yeah, so you've got your pension trustees. There's a trust deed, typically a relatively standard document, and that trust deed says that the beneficiaries under the trust are Joe Bloggs for as long as he shall live, and then Mrs. Bloggs, and the wee Bloggs is when Mrs. Blogg passes. So that legal instrument, it means that what again, it's difficult for the Italians to get their heads around, because they're thinking, well, maybe we should apply trust law to all of this. Yeah, maybe this is just ignore the word pension on it, and we should be saying this is a payment out of a trust. But whatever ways it goes, if you just step in as a beneficiary under a trust, then you don't have any liability to income tax until such time as the trustees give you some money. When they give you the money, if it's got the word pension written on it, the Italian tax agency are going to say, well, that's a pension liable to tax at 40%. And you've got to take the argument to them and say, no, actually, I think this is, it's not my pension. I never paid into it. My husband did. My wife did. I didn't. And this is actually a sum of money that's a return on an investment, 26%. But I've not come across that, so I wouldn't like to give you a definitive answer. And again, typically we might be thinking about doing a ruling on that specific case, asking the Italian tax agency for a ruling.
Okay, I think that's it. I think we need to this came directly from a question we were just asked, actually. So I think we need to probably speak to them, give them the right advice. Moving on, I know we've overrun with time. Thanks for everybody that's still with us. The majority of people are, a few people have gone, understandably. So we'll be emailing this out anyway. Been asked a lot of questions. It's a lot to try and type and talk, so apologies if we haven't answered them live. We'll try and get the Q&A in at the end. I'll just breeze through the last couple of slides. Looking at currency, we've already talked about this a bit. Question asked a lot, is it a good time to transfer now if you've got, for example, a pension or a large amount of money in sterling into euros? Based on the historical average, the answer is no. Is the pound going to go lower or higher? It's anyone's guess, really. We've all got opinions on that. I've actually created a poll for this. I'm going to launch it now. So if you can see this on your screen and you fancy letting us know your thoughts. Can you see this, Adam?
Yeah, can see that.
Excellent. So how do you think pound will perform versus euro in the next 12 months? Lots of answers. A couple of people saying not sure. That's good. You don't have good. Okay, interesting. So not necessarily. Oh, brilliant! It's like the Eurovision Song Contest is. More exciting than the US election. Okay, 32. Oh, keeps changing. A lot of people think pound will be a bit weaker. I mean, bear in mind we've got two moving parts here. You've got to consider what's going to happen to the euro in the next 12 months as well. Okay, interesting. A lot of people on on that side of the fence, thinking that sterling's going to be a lot weaker. What are your thoughts on this, Adam?
Yeah, well, it depends what happens with the trade deal, the negotiations which are going on at the moment. Because if they do manage to cobble together some sort of trade deal, which, despite all of the bad press, is probably going to happen, then you would expect, sterling is historically low against the euro. You would expect sterling to come back at some point. If there's no deal, I mean, I spoke to a couple of investment managers about this and about how long they think, because sterling would stay low, because if there is no deal, sterling could well go lower against the euro. Plus, we've now got Biden presidency, which is potentially good for Europe, because Trump was quite anti-EU, so the EU has been quite subdued. The euro has suffered a little bit for that. Now we have a bit more of a positive feeling around Europe, and with Biden in power, because Trump was coming for the EU next with his trade war. But they seem to think that whatever happens, give it 2 or 3 years and sterling will be a lot stronger. And this is the sort of line that we get asked this quite often, because obviously we deal with a lot of people whose money is in sterling, but they want to come and move to Italy, and suddenly their primary currency is euros, so they have a bit of an issue, in that if sterling drops as it has since the referendum, suddenly their spending power is a bit reduced, if they're drawing on pensions and so on. And for the time being, our advice has been to exchange as little as possible into euros, because the likelihood is that sooner or later sterling's going to come back up. I mean, no one knows whether that'll be in 12 months' time or not, but you would imagine it will happen at some point, unless things get much to UK. But despite all the problems the UK has, there's still a lot of high quality companies. It's got potential to be a strong economy.
Yeah, good. I think my view is that I'm always quite confident in the UK, and although I don't agree with Brexit, I do think that it will all be okay in the end. It's just when the end is, whether that's 5 years or 10 years, I think sterling will always be a strong currency. I mean, when I moved here 5 years ago, it was 1.4 to the euro. So it was a no-brainer then. If you were living here and you had, for example, a pension, you could transfer it into euros to take advantage of that. I think the historical average is probably around 1.2, 1.25. So now at the moment it's 1.1. Even if I was pessimistic, I still probably wouldn't transfer a large amount, because I don't think there's good value in that 1.1. But yeah, so I mean, on this issue as well, and just good, so I'll end up following there. Just good advice in general. If you are transferring money into euros, try and avoid doing it through the banks, just because they seem to be the most expensive option. And there's a lot of lower cost alternatives now. Probably familiar with TransferWise. Recently I moved like 10,000 from pounds to euros, and there's like a £500 difference, about 5%. So it's pretty huge. If you need to transfer large sums, for example, if you need to buy a property here in Italy and you want to use a large amount of cash that you've got in the UK, better to work with a broker. We've got a few partnerships, so we can introduce you to someone who's going to manage the relationship and make sure you get the best rate, and to help you to do it at the right time as well. So for smaller amounts, use a service such as TransferWise. For larger amounts, use a professional broker. Best advice we can give you on that. Final slide, covering the recent topic, which was in the news about UK banks closing accounts of EU customers post-Brexit. At first, I thought this could just be a sort of headline story about nothing. Couple of anecdotal experiences. Had a client, I think their account was with Lloyds. They read this about maybe their account's going to be closed. They closed. They phoned up Lloyds, their bank, and they were told that there's no need to worry. We're only closing accounts for people in Slovakia and the Netherlands. I don't know why those two countries, but that's what they were told. So the best advice here is to contact your bank. Don't wait for them. I have heard of banks writing to customers saying, okay, from January, your account's going to be closed if it's not linked to a UK address. So at least then you've got a couple of months to find a solution. So if you are in that position, then again, these online banks, and we don't have any relationship with these or any interest in sort of recommending. This is just suggestions really. Look at online banks such as Revolut, or banks that have specialist expat services like HSB Expat, although I believe you need a minimum of 50,000 as a balance for that, and then the account would be actually in Jersey. You can look at multi-currency accounts, for example, in the Isle of Man, like Standard Bank. Again, these do tend to be quite expensive. And back to the issue of pensions, not wanting to pay to a non-UK bank account. I think in the example of Revolut, Adam, they've moved their banking to Lithuania. So your IBAN would have a Lithuanian prefix. So even though it's in sterling, I still think maybe a lot of UK firms wouldn't want to pay.
Yeah, it's Revolut are using their Lithuanian subsidiary, so all of their accounts for non-UK residents now have an IBAN that starts with LT, I think it is, or something similar. And TransferWise have done the same thing actually. They've got a Belgian subsidiary, so all of those accounts will be transferred across. I think it's mid-December. So yeah, there is a potential problem with this because of some pension schemes in the UK will want to pay to UK bank accounts where there's a sort code and an account number in the kind of traditional way. If they see a Lithuanian IBAN, they might not do it. We don't know what's going to happen yet and whether the pension schemes will change their policies and so on, but it's something to look out for. And there's an article on our website about that. So if you think you might be affected, have a look at that.
Yeah. Also, just call your bank, basically. That's advice I can give. I mean, to me, it seems strange because there's plenty of individuals outside of the EU in other, like I used to live in South Africa, people there who have UK bank accounts. And I don't know if it comes down to the issue of having a UK address on your account. I mean, I have a UK address on my account, my parents' address, and probably legally it's probably the wrong thing to do. So I don't know really. It's
well, it is to do with the addresses on the accounts, because if you don't have your address here on the account, they don't know you're here.
Yeah, although I do have the Italian phone number as my contact number, so they're not stupid.
No, but I think it is a commercial decision.
Yeah.
Because if you look at it, there's lots of Americans, for example. We also deal with quite a few Americans. Lots of Americans here in the EU, in Italy, who've got American bank accounts. It's absolutely no problem using American bank accounts, but it might be more to do with the cost for the banks in dealing with people in the EU and no longer being a member, and the fact that they can't cross-sell other products, because banks often make money. Current accounts are a bit of a loss leader, whereby they give you a current account for free, but in reality they want to sell you other services, insurance, savings accounts, mortgages, whatever. If they can't do that, there isn't much interest for them in dealing with people in the EU. So for them, it's a cost-cutting exercise to just say you can't have an account anymore. But we'll see what happens with that. Again, at the moment we're kind of in this sort of period where we don't really know what things are going to look like from January in terms of the UK EU relationship on many things. So, but as Tom says, if you're concerned about it, call up your bank or call up your pension provider if you think that there might be an issue post 2020.
Yeah. I mean, I think everyone needs an account for sterling, even if it's just for spending money when you go to the UK. No one wants to be a prisoner of one currency, do they? No. Okay, I think that concludes the webinar. Apart from the Q&A, I mean, we've got a very full question and answer box. So one thing I'll promise is that if we don't answer your question now, we will email you an answer. I mean, I'll probably just, if I cherry pick a few which seem to be the most broadly relevant, let's say, someone asked about, can you see that? You can both see the questions, can't you, Colin and Adam?
Yeah.
NHS pensions to a resident in Italy, I believe they're taxed at source, aren't they, Adam? Colin?
Yeah, they are. Those are a civil service pension, so they're always taxed at source, aren't they, Colin?
Well, it's a moot point, and I've been trying to bend anyone's ear in the embassy, not that anyone pays any attention to me, to get a bit of guidance. I mean, the double tax treaty is very clear. Basic rule, your pension in the UK-Italy treaty, basic rule is you pay tax only in the country of residence, yeah, on a pension. So if you're a resident in Italy, tax resident in Italy, UK pension, you've got to write to the DHS or HMRC, whatever they call themselves now, and say, don't withhold tax anymore. I'm resident in Italy, and can you please pay the money gross? Or they will actually do a deal that up until Brexit, they will work out with IMPS. So you get your pension paid via IMPS, subject to withholding tax here in Italy. Then there's an exception in Article 19 to the treaty, which says that if one, your pension is paid by government or local authority, and two, it's in respect of government service, then it's the other way around. It's taxable only in the country that pays the pension. So if you've been a UK civil servant, no doubt whatsoever, UK diplomat, taxable only in the UK. As long as you haven't asked for Italian nationality, because then that brings you back to the basic, yeah? But let's assume we're talking about people who've only got UK nationality. The problem is, what does government service mean? And does it include, you know, a nurse or a doctor that has worked in a private healthcare, in a scenario, private clinic? What about an NHS trust? Is that government service? I don't know. And unfortunately, we've just got to this position where we can't get any guidance off anyone because of Brexit, and no one's, you know, they don't talk to each other. So we're in limbo land. And we can request a ruling, but the ruling will give you the views of the Italian tax authorities, which are taxable in Italy. Yeah, whatever you ask them, you know, is it taxable here or there? They'll say here. So it is a little bit difficult. I tend to, for NHS workers, traditionally, I tend to say that is government service. You know, and that was true in the past. Yeah, but, you know, so much is getting privatized. The US-Italy treaty, interestingly enough, also defines government service a little bit more broadly, and also includes private subcontractors to government, which could actually be a very vague. But the UK-Italy treaty doesn't have anything like that. So, you know, you pays your money, you takes your choice. Nobody's going to get terribly upset as long as you're paying tax somewhere. Yeah, I've never seen, you know, for a pensioner, you know, normal pension, I've never seen them having a go, yeah, where you're paying tax in one of the two countries, even if it's wrong under the treaty. It's just not on their radar. They've got a lot more bigger fish to fry than pensioners.
Yeah. Thank you. Yeah, there's a question just come in, and actually it's reminded me of something I meant to say earlier, talking about pensions. So for people that haven't moved to Italy yet, and if you have a UK pension which you can access, of course, if you're a UK resident, you get the PCLS, the pension commensurate lump sum, which is 25% tax-free. And a lot of people don't realise that once they leave the UK, they no longer get that tax-free. There's double tax treaties, meaning you only pay tax in the country where you're resident. So because you're not a UK resident, you're not going to be subject to UK treatment. So you're only going to get the treatment wherever you are in the world, not just Italy. So if you're in this position and you're considering a move to Italy and you have access to your pension, take out the 25% before you leave. Because once you get here, it's too late, unless you go back, you know, unless you don't touch it and then go back to the UK, of course. So for example, the UK SIP, which you can access from the age of 55, try and take that out. So in financial planning point of view, you could theoretically, if you imagine having a pension of $500,000, take out 25% tax-free in the UK, move to Italy, have a year-long holiday, take out the rest of it, pay 7% tax on that, an effective tax rate then of about, what, 5.75% tax, and then the money's clean, it's in your hand, you pay tax on it, you have it invested, no more income tax to worry about, and then you can freely move back to the UK a year later. I don't know why you'd want to, but it is something that you could do in practice. So from a financial planning point of view, take out that lump sum before you leave the UK. Makes the most sense. Someone's asked, do transfer-wise accounts, are they classed as foreign assets in Italy? I believe so. Any foreign bank account, really. I mean, you do get a threshold, don't you, though? That 0.2% that you have to pay is only on balances above, is it 10,000?
Yeah, well, first of all, on bank accounts, you pay a flat 34 euros a year. Yeah, that and again, that's the equivalent of the stamp duty you pay on an Italian current account. So the worst case scenario is 34.2 euros, which must have been 70,000 lira, something like that. We've still got all these funny numbers from 20 years ago. You only need to pay that tax if the average value over the year is more than 5,000 euros. And you don't need to declare it in your RW, the closing value, because your bank accounts, you've got to disclose the opening value and the closing value, but you only need to disclose if it's more than, closing value is more than 15,000. So you've got two tests. One, is it more or less than 15,000? If not, you look to see if you've had an average of 5,000 euro with that particular financial institution. Yeah, and any other accounts with that financial institution. Yeah, so I think, yeah, I've got two TransferWise accounts, one for business, one for pleasure, and so I would, you know, when I look to see whether I need to declare it, I've got to lump those two accounts together. But typically, I don't keep more than 5k in the two accounts. Actually, I make jolly sure I don't by shuffling it around to Revolut and you know, wherever else I can think of, just to annoy them. But the 5,000. But the worst case scenario is 34.2 euros on bank accounts.
Okay. On the subject of state pensions, someone's asking. So, I mean, theoretically, you could be resident in Italy and maintain voluntary contributions to UK pension, I understand, but also contribute to the Italian state pension. So you can end up with two state pensions. Is it possible to merge them so you only receive one payment? I don't think so. Adam, Colin, don't know if you have thoughts on that. This is a question that came in from
you can merge them, can't you? I think you can claim them both through IMPS. But this is not something that I've ever dealt with. Have you had experience with this, Colin?
No.
No, but I'm sure that you can. You have to claim them via IMPS. A lot of people choose to claim them separately though, because apparently it's a real hassle. I think I've had two clients in the past who've attempted to do it, and I think one of them managed it. The other one, it took so long that she ended up claiming her UK one. Claimed her UK one and then claimed her Italian one separately and got paid the two separate.
I can't really see an advantage to merging them. I think having a UK state pension and an Italy one kept separate would be.
If it was a simple thing to do, there might be just a sort of convenience argument for it. But I think anything to do with IMPS has the possibility to become quite slow and complicated and involve many trips to your local IMPS office, which is never a nice experience.
Yeah.
I'm not really following the question. Is this Damien's question?
Yeah.
Hi, Damien. 35 years ago, I like to pay to Italian state pension. Well, if you start working in Italy, you get to pay to the Italian state pension. Quite why you'd want to take on a liability of 20% of 25.7% of your 26% of your income to IMPS, I don't know. But you can't merge the contributions. You've never been able to merge. The way that under EU rules was that it was totalization. So you know, if in the UK you need, you know, what is it, 15 years to get the full pension,
and yeah,
and you do 10, you'll get 10/15ths of the UK state pension, but your years in Italy will count towards those 15 years. So if you've done 5 years in Italy, you've reached your 15 years to be able to get your 10/15ths. You can't merge. I mean, merging would have been a great idea if the EU had been able to put that in, get that into place, but there was no way they were going to be able to merge. So you basically talk about merging, you know, gigantic pension funds, you know, some much better funded than others. So you know, that was just never going to happen. So everybody gets the pension from the place where they've contributed. And Italian law says that if you set up as self-employed or you're an employee in Italy, you have to pay the state pension. You have to pay into IMPS, yeah, unless you're a professional and you've got your own Casa Professionale. So I don't think you can merge. We were looking about the possibility of transferring out of a SIP into a regulated Italian pension scheme. I didn't talk earlier about regulated pension schemes. They call it a special tax treatment. It's 9% to 15% substitute tax on the way out, which looks quite nice. But the problem is that the pension fund itself is taxed, yeah, on the income on its investments. So if you were to look at the overall return on your investment into the pension fund, you'd find that the tax rate was probably, you know, a lot higher than the effective 15%. But I think it is, according to the tax agency, certainly is possible to transfer from a UK scheme into a private scheme if you wanted to do that. Yeah. So I can say legally it's possible. Whether you'd be well advised to do it, you need to speak to Adam and Tom and you know, look at the thing in the round. But you can't. It's very difficult even within Italy to do a merger of pensions. You know, where you've worked if you've worked as self-employed and then employed. A lot of Italians have problems putting those separate pension schemes together. So from the UK, I'd say it was a dead duck. The only thing you've got is administrative arrangements where you can get IMPS to, you know, to pay your UK pension, but they're just acting as a paying agent on behalf of the UK government.
good. Yeah, I think that's most of the questions covered. There's a few we haven't answered. I think they're more individually sort of specific to the individual, so we will email you, get back to you with answers on those. 2 hours ago I said we wouldn't still be here in 2 hours. Actually we are, but I hope you've all found it very worthwhile and beneficial. Is there anything else to add, Adam or Colin? Anything you left out that you want to mention?
No, I don't think so. I think you know, feel free to get in touch if you've got further questions.
Yeah.
Like to speak to any of us.
Yeah.
Yeah, and God help us all after Brexit. The fun is just about to start.
Yeah. Yeah. Good. Okay. Well, thank you all so much for your attendance. Thank you for the majority of people still with us. We will be emailing out a recording of this. Just need to sort that out myself and then send that through tomorrow. I'll send through recording, send through the slides as well. So you've got all the information there. And maybe a few useful links as well. So we'll send a full follow-up tomorrow. Of course, very easy to get in touch with us. Find our website, valiant-wealth.com. There's a useful page on there for Italian expats, expats in Italy, should say. Lots of articles on there. Colin's own website, taxing.it, fantastic resource for a lot of the things we've talked about. You can download PDFs and get useful information off that website. If you want to contact us, info@valiant-wealth.com. Google us, there's contact forms on the website. Pretty easy these days to get in touch, isn't it? So no excuse not to. Okay, thank you all for your time. Stay safe and well wherever you are, and yeah, look forward forward to speaking to you soon. If we do future webinars, stay on our mailing list and we'll be able to let you know about them. Thank you guys. Take care.
Yep.
Bye.
Thanks. Goodbye, everyone.
Bye. Bye.